Welcome, everybody. Welcome to the event, Clean Tech Investing in 2013. Where are the new opportunities? I'm Gavin McCraley, MC, and one of the managers for this event, and also a corporate attorney at Morrison Foerster, one of the proud sponsors of this program. Morrison Foerster is also a law firm that has a significant presence in pretty much all aspects of the clean technology sector, from venture-backed companies to large mature enterprises, and from practice areas from IP to financing and so forth. So very happy to sponsor this event. This program is part of the Energy and Clean Tech series put on by the MIT Club of Northern California. This is a monthly program running roughly from September to June, so about 9 events a year. Number of formats, one of them is a panel presentation like we have tonight on topics of interest. Another one is visiting professors that are affiliated with the MIT Energy Initiative that come out and do presentations on their projects at MIT as well as other areas of interest to them. In addition, recently we've had some very interesting events with notable individuals such as the CEO of PG&E came out and talked with us in one of last year's sessions. And we also have some interesting events such as site visits to other areas of note, like the recent ISO control room visit that apparently was well attended. In any event, we certainly hope that you enjoyed tonight's presentation and that this adds to the value of the series for you all. So without any further delay, I'd like to turn it over to Quentin, the moderator for today's event.
All right, thanks, Gavin, and welcome everybody to Silicon Valley Bank's global headquarters. This is the center of the action for Silicon Valley Bank, and we're super pleased that all of you are here. It's a huge crowd. Fortunately, it didn't rain, and this room usually has a bunch of tables, so we moved them all out to fit everybody in. So I'm just going to say a few words about Silicon Valley Bank and then introduce each of the panelists one by one, and they'll get up and talk a little bit about their firms and involvement in clean tech. And then we'll have a little bit of a roundtable discussion, and then we'll open it up at the end for questions. So, and I think the panelists will be able to stick around for a little bit at the end if you want to do some one-on-one questions for those folks. So let's get started here. Let me see if I can. Okay. There we go. Well, as I said, I'm Quentin Falconer, and I work here at Silicon Valley Bank. I'm the National Clean Tech Coordinator and work with a group of 6 people in Northern California and handle, pretty much as many clean tech clients as we can convince to come bank with us. We do general banking, and the biggest thing is we lend across a whole life cycle of clean tech companies, from early stage venture debt to later stage working capital finance. The bank's been around for about 30 years, and we started right here on the West Coast, hence the name Silicon Valley. And I guess Silicon Valley is everywhere, and we expanded everywhere. We first built out a national footprint, and we have now we have 27 offices across the U.S. And about 10 years ago, we started to expand internationally, kind of following the VC and client action overseas, first in India, first in the UK, India, Israel, and China. And let me go to the next slide here. I only have 2 slides. I really kept this short. There we go. So our focus here at the bank is on technology companies. So we kind of break up that world into hardware and software and services. And we have a whole bunch of software and services companies. I mean, really, if you look at venture activity, the bank's kind of follows where that activity is. We have a separate life science practice, and in here, you could see in the biggest and most important of them all is, of course, clean tech. We also bank directly the venture capital firms, and we have a private equity group. And many people know, but some don't, that we actually have a premium wine business, and there's many stories about its tie-in to technology, and I can spin you a bunch of tales on that, but we're really pleased to be in that business as well. So that's pretty much it on the bank. I kind of want to leave the glory to the panel here. So the first person that I would like to introduce is Dr. Cheryl Martin. Cheryl is the Deputy Director for Commercialization at ARPA-E. Many of you are familiar with them, but you will hopefully know a lot more after this evening about ARPA-E. She was previously executive in residence at Kleiner Perkins and spent many years in industry at Roman Haas. So perhaps, Cheryl, I'll get your presentation up here, and maybe you can come up and say a few words about ARPA-E's activities and your role. Let's see if we can get this here. And
Our first tech challenge. Can we get it up?
there we go.
There we go.
Okay, oops, a special security
Security
thing.
alert. It's the government.
You work for the
Don't
government?
worry.
Yeah,
It's
okay,
happening.
there you go, it's all yours.
I'm the government. We're here to help you. It's going to be all good. All right. Good evening. I'm really glad to be invited to be here and participate in this conversation tonight. So I want to just talk a little bit about what is ARPA-E's mission, how we're distinguished from other agencies who do energy funding, and a little bit about what we fund. It's really good timing to be here because we just announced $130 million of projects on Thursday. And so it's a great time for us to be kind of putting another stake in the ground for energy funding. But let me start at the beginning. Let's really go at the beginning. So ARPA-E has a mission that's a mile wide. You could drive a truck through this, right? Our mission is to catalyze and support the development of transformational high-impact energy technology. Very much around three areas of energy security, environmental security, and economic security. So it really is a very, very broad mission. But the real important part about it is how we actually do what we do, and I'll talk about that in a second. ARPA-E is very, very young. We're a 3.5-year-old agency. We were envisioned back in 2006 as part of the Rising Above the Gathering Storm report, which was commissioned by the National Academies, where it was of concern for the loss of technological edge in science and engineering by the United States. And in that report, they recommended the founding of an agency like DARPA based on energy. And so I guess our metrics of success ultimately will be if we have the Internet of Energy, all will be good. But we'll talk about some closer in metrics than that. We were actually founded under the Bush administration in 2007 as part of the America Competes Act. But as I've learned in my past year in government, we had no money at that time. The money came in 2009 under the Recovery Act, first $200 million in funding. And at that point in time, there were three program directors showed up bravely into Washington to evaluate several thousand concept papers in an open call for solicitation, and chose the first 37 projects that ARPA-E funded. Since then, we have had 2 years of line item budget as part of DOE. This past year, $275 million. So, it's a significant piece of money going to early stage energy investment. But again, in the big picture of all of this, we are quite small and quite new. And so some of the things that we do, every day is an experiment at ARPA-E. If you go to our offices right now, it's one floor. We look very much like a startup. It's low cubicles, all glass, both sides of all offices. And what's not glass is painted with whiteboard paint. So we look a little bit like a kindergarten at any moment as well. A lot of writing on the walls. But since we've been founded, as of last week, we've funded about 285 projects, $770 million out there in the United States across a number of project teams looking to transform the energy landscape. So when we look at, well, what makes an ARPA-E program, there's really kind of four key questions that we look at. The first one is impact. Is there a big enough market? Often in energy, the answer is yes. Is there a credible path to the market? So is it going to matter? Is it going to be transformational? And probably this is the knockout factor for most things that we get that we can't fund. We're not doing basic science, but we're also not driving things down existing learning curves. And so if it's not a transformational idea that'll go beyond where we see existing learning curves, we can't fund it. That's not our thing. And so often when we're looking at funding, it's not a question of does it work? It's if it works, will it matter? And that really is a conversation we have quite a bit in all the different sectors in which we fund. It's, again, bridging. We're looking at bridging between science and the applied sides of things. Is it going to be something that as we fund this space that somebody will come in next? We've risked it down enough for the next stage funder to come in. And what about the teams? When you look at who we fund, about half of our awards are to academics as a prime investigator, about a third are small business, about another 20% are larger business, the national labs, and nonprofits. And so that's the primes, but very often there's a teaming structure. Other larger companies teamed up with universities, specialty nonprofits who are in a particular sector, very much pushing the boundaries of what team needs to come together. Just like you would ask if you're looking at venture investing, right? Is the right team going to be in place to move this forward? So what have we funded? After that first call, we ran 14 focused funding opportunities. And when we look at a focused funding opportunities, just like a DARPA model, a program director will come in and make a pitch that $30 to $40 million invested in this space is going to move the needle. And then we'll go out with a call and we'll invest in 12 to 15 projects in that space. And so we tend to break the world into transportation and stationary. And so transportation, everything from electrofuels. Can you feed non-photosynthetic microbes, carbon dioxide, and some source of electrons to generate fuel? And petro, can you re-envision plants that have been growing for a long time to be plants? Can we re-envision them as an energy crop with the oil traits of algae into tobacco plants so that you're not harvesting tobacco as a beauty crop for its leaf quality, but you're actually able to pack it densely enough that it becomes an energy crop. Loblolly pine produces terpenoids naturally. Can you double and triple that level so that you could truly think about tapping a tree to generate energy? Our electric vehicle program, doubling the energy density of the battery so that you could have electric vehicles with no subsidy. Natural gas vehicles, our MOVE project. Could you envision natural gas being used in passenger vehicles and so that you could tap the home energy system for the home energy natural gas system for recharge? And so there you've got things from conformable tank design all the way to compressor technologies coming together. If you flip over to the stationary use side, everything from the software and the hardware to make the grid routable, grid level storage kind of projects, power electronics for both solar applications as well as broader electronics applications, energy efficiency, right? We don't run air conditioners down a very efficient part of the, we tend to use temperature to dehumidify air and then warm it back up generally to have it be something that we can sit around in. Can you ride a different efficiency there? And then you have some kind of that bridge both sides, amped power electronics, the sensors and the technology to allow you to understand where is the battery, what's the battery lifetime, what's the battery capability. React, the whole question of rare earth materials and the not necessarily a direct energy implication other than you think about if you're going to drive wind turbines and EVs, the whole idea that we may not have enough rare earths available to us would cause you to run a project like this where you envision magnets and motors with little to no rare earth component in order to have them work. So really out of the box, turning ideas on their sides to say, are there other answers that we can come up with? And the one we announced last week, 66 projects across 11 areas. Everything from advanced fuels, vehicle, everything from materials design, some really interesting building efficiency projects, some window projects. We've funded some things about sugar beets as an energy crop. We have dust devils. Can you tap bring together the heat off a desert floor in the vortices that form? We've got water waves inside a flowing water stream to pick up energy. A lot of really, really interesting projects, and so we're just starting the negotiations with all of these investigators looking at what's possible there. And so as we think about this, the top here, the blue, this is what you do to manage projects. We identify a white space, we identify some projects, and then we work with those projects. But at ARPA-E, it's not just the development of technology, it's the deployment that we focus on even at early stages. And so if you think about what has to happen to make that come together, you need to understand how are the people going to work on the project to create value by implementing that idea, right? It's truly the definition of innovation. And we work really hard to help our teams understand the markets and the techno-economics under which they need to work in order to move that technology to market. What are the skills and resources they need to have to be able to actually tell their story, pitch their message? Who do they need to be able to tell it to, and why should that be different? And what about the stakeholder engagement? Who are the people that are eventually going to bring that to market, right? We talk about energy technology. I'm sure we'll touch on it as the panel. Deployment is a big question. And so do you need to have the utilities be part of this, or is it just a piece for potentially small companies engaging. So we worry about this a lot with our teams. And finally, we bring everything together once a year in DC. 2,700 people get together to look at all these technologies. And it's really one big geeky energy festival. We get people like Bill Gates, and last year we had Bill Clinton show up, but they're the icing on the cake. The real thing is the technology and the networks that form by people being together, looking at how these things will move forward, how the innovation potentially are going to marry together to bring us to some really interesting places. And that's why when we talk about what we're trying to do, it's changing what's possible. And so I will turn it over to some of the other panelists to go through some of their other areas as well, and welcome your questions.
Thanks, Cheryl. If you guys are like me, you know a lot of companies, or about a lot of companies that get ARPA-E funding, but it's kind of insightful to see the criteria by which ARPA-E does the evaluation. I thought that was very useful for us. So the next person we'd like to have up, next panelist is Ray Rothrock, who's a partner over at Venrock. Ray's been in the VC business for over 20 years. He initiated Venrock's energy investment strategy, and he's chair of the National Venture Capital Association. So, Ray, it'd be great. I'm going to get your presentation up here if you come up and tell us a little bit more about yourself and Venrock and clean tech. Let's see what we can do here. Get you all set up. Okay. Well, where's the full page on this? Maybe you'd be better at your own prezo. What do you think?
Let's go to presentation.
Okay, I'll let you do it.
It's a PC, I don't understand it.
Yeah. Let's see. Alrighty, here's a tutorial. Fun view, page display. Oops. Single page view. Where's full screen? There we go. Oh, full screen on there. Okay, I got it. Alrighty, there you go. You're all set.
Good man. All right. Thanks, Quentin. Appreciate that. Okay, good evening, everybody. It's funny. I gave my stick to Doug earlier, and I just never know what's going to show up. So I hope all my slides are here and not someone else's. I'll do my best. So Venrock. Venrock started back in 1938 by Lawrence Rockefeller. As you probably all know, Rockefellers were in the oil business some time ago. And in those days, investments were a lot about energy, transportation, communication, things like that. And it's carried on many, many years now. And in 1969, it formed up to be Venrock. We have offices now in Palo Alto, New York, and Cambridge, Mass. All in, we've deployed about $2.6 billion in 450 companies in the past 40 years. We've had 128 IPOs, and just some interesting stats. We've been around a long time. We have a long-term view of the world. The Rockefeller family divested part of their interest in Venrock starting in 1995. They still own about 20% of us. So we still report to them, and they're very curious about our energy investments, to say the very least. Me personally, I'm an MIT graduate in Graduate School of Nuclear Engineering, course 22, just to translate that for you guys. And I've done 52 deals, hopefully 53 here pretty quickly, and I've had 7 IPOs in 25 years. So when energy came back cool in the 2000s, I was like really excited because I started out in energy. I love energy, but I somewhere along the way got into software infrastructure, cybersecurity, and a few things. All that, interestingly, is coming to play in the energy realm today. So Matt Trevithick, who's here with me tonight, my partner, joined us in 2004. It was a curious meeting. He was pitching an energy deal that my partner Tony Son and I liked very much, but decided not to do. And it's one of those meetings where you tell the entrepreneur, I've got some good news and bad news, and he of course says, well, I know what the bad news is. What's the good news? I said, would you like to work for us? And it took him about 12 and a half seconds to say yes, and he did. And so he and I sat down and started thinking about this whole energy world that was evolving. And nobody remembers 2003 or 4 in those time periods, but literally on Sand Hill Road, there were these people from the late 90s out of the software infrastructure industry, the internet industry, who were married up with these PhDs from the 70s out of Berkeley's wearing Birkenstocks, literally with slideware pitching solar deals. I mean, I bet we saw 80 of them, if not 100. It was amazing. So we said, whoa, stop. You just can't do all these. What's important, what matters? So Matt and I took a big breath and stepped back and put together a strategy that really focuses on new ways of either generating or efficiently using electrons, which is key, right? We all live on electricity. hydrocarbons or other resources. And so over the last almost decade, with a team of 5 or 6 of us, depending upon when you look at us, we've invested in about 15 deals. The portfolio you see here, we divided into electrons, hydrocarbons, and other things, like water, for example, which is a big deal. We don't have any water investments yet. But you'll note here, there's no solar, because we don't believe in subsidies. Subsidies only whack up market attitudes. They go away. Our government can't make its mind up. A key element of any strategy as an investor is you have to have consistent policy or consistent physics. Either one, I'll take both if I can get them. And so you can see here, like in electrons, you know, we have some fundamental deals, Tri-Alpha Energy, which is a nuclear deal in Southern California, Phononics Devices, which converts heat to electricity or electricity to heat. This is a really cool deal, going very nicely. On-chip power, this is VHF power supplies and things like that. Then over in the hydrocarbons, we have Sapphire, which is Southern California, but with a facility in New Mexico. And thanks to the DOE and the USDA, we're actually producing crude that can get right into the pipeline of feedstock, and out the other end comes $70 a barrel equivalent gasoline, which is very economical in today's environment of $100 a gallon. So we went after fundamental things that were economic without subsidies. Now that implies you're in it for a long time, because anything takes a long time to come to market. Example, Venrock's been in pharmaceuticals since 1972, and I've been around not quite that long, but I've seen a lot of pharmaceutical deals. They take about $300 or $400 million. They take 4 or 5 years to get the science right, 2 or 3 years to get stage 1, another 2 or 3 years to get phase 2, and then maybe you're in it for 15 years. We understand that process. We understand the risk involved. We understand the whole notion of bringing in the sort of risk profile of stepping up valuation as well as raising the capital necessary to get through the next phase. So with that background and talking to our healthcare partners, we started putting together a portfolio that kind of looks a little bit like that. And I'm glad we did. I'm glad we didn't jump into it like a lot of IT guys were thinking about this is going to be up and to the right and, you know, IPOs in 3 years and life is good, because it's anything but that. So this summer we asked ourselves a question. We've been at almost 10 years. We're in our 3rd fund with energy investments in it. And so we said, what have we done? What's the industry done? How many of us are in the industry? How many deals have been done? How much capital has been deployed? You read all this stuff, but you know, you really don't believe it. So you have to do the work yourself. So we, there's a bunch of words here. This is from another presentation, but basically we took some smart people and scraped every website we could find in the venture capital business about energy deals. And we found 345 energy deals. And these were probably the ones that are still alive, not the ones that have long passed. But 345 deals, and we evaluated those. We set up some criteria, and we evaluated them. And asked ourselves, are they any good? Are they okay? How'd they turn out? And we found 63 with potential that we thought were of some merit, venture merit. And you know, venture capital, you got to have certain returns in a certain period of times. So a lot of deals that are done, they probably are not venture deals. That doesn't mean they're a bad deal, just not a venture deal. So if you think about developing science, then that gets moved into engineering, where you've taken a science and turned it into a technology. Then you've taken a technology and made it economic, and so then you take it to market and try to sell it. And when you're selling energy, electrons, or hydrocarbons, it's a commodity business. You cannot charge skim prices with big margins. So you're in the commodity business. So if you look at that pipeline, you can see here we had 11 in science of the 63, 17 in engineering, 22 in market, and 10 stars. Well, who are the stars? So I don't know if you can see this, it's kind of faded here, but you know, Tesla's public, $308 million of venture capital invested, started out in 2003, a lot of VC investors there. Nest, O-Power, Sunrun, you all know these names, but these are the stars we found, deals that have gone through the entire cycle from science all the way out to market development and market success. It's not a very big list, is it, out of 345? So I had the list of companies here, but it would have just been too much to absorb, so I'll just quickly flip through these slides. So who invested in all these 345 companies over the last decade or so? So this is a quick list. We just did a histogram, Excel there being the first one. They had 9 total energy investments we could find. Green means the deal we thought was positive or going the right direction. If it's a gray, it was too early to tell. This is of the 63. So you can look across there, you know, picking on my own firm here. Venrock's the, Theo, on your right there, Venrock, we've done 11 deals. We think most of them are good, of course. You always think your own children are the best. But we have had some trouble along the way. But you can see here, you know, a lot of big bets, a lot of swings. So it's been kind of a for a while there was a lot of people participating in this business, and part of any venture strategy, whether it's healthcare, tech, or energy, you have to have a plan for how you're going to raise the money and from whom you're going to get it. In fact, one of the things that I hope we talk about later is one of the things that has not developed in the venture space is really a close relationship with industry, unlike the pharmaceutical guys, which got deep into the knickers of the venture guys, and IT with the big IT companies. We've not done that, I don't believe, as successfully in energy as we should have. But we're all facing that because all these companies are going to need more capital. This is the clincher. So in August, we said, what are all the public energy companies? And where have they stood vis-a-vis their IPO price? So from their IPO until mid-August, only one is in the green, Tesla, about a $3 billion market cap. All the rest of them, Venrock, Solazyme, Intermolecular, you name it, are all underwater from the IPO. So what does that tell us as venture capitalists and also our LPs? There's a little bit of timing on the exit. You got to get out when the getting out's good or when you can. You know, these companies could come back. I'm not sure A123 will, since it's trading at like pennies relative to what even initial investors. But it just simply says that, look, markets go up, markets go down. These companies probably need more capital. When you're way under your IPO offering, it's hard to raise money. So I'm not sure how this is going to play out, but this was a really depressing slide, if you think about it. But, you know, if you've got a long-term view of the world as the Rockefellers had, and our DNA is all about, you know, doing things that haven't been done before and going down roads that have never been driven down, then you kind of take a different view. So what are the conclusions? Clean tech has been a hard road to hoe. It really has. I think the capital deployment, we're probably, you know, I did an analysis once of IT, and if an entrepreneur comes in and says, I need $10 million, the truth is he needs 25. That's what the data tells you. I don't know what clean tech is. If they came in and said they needed 100, whether they need 500, I'm not sure. But it's a hard road to hoe. You have to have a financial strategy better than your business strategy, even better than your engineering strategy. You really do. Clean tech has had fewer successes, but I think we're still early. We're sort of mid-innings here. We're not in the 9th inning. We're probably in the 3rd inning of energy. Mark Heeson, who's the president of the MVCA and has been doing this for 25 years, he thinks energy is the big area for venture capital. But we just need a LP basis, patient, so it talks about communication and sort of upstream, making it visible to them that this is a long-term bet. I mean, without energy, none of this works. And then clean tech deals have to have a strong, capable CEO. What I mean by that is they have to be able to raise money. I mean, really, at the end of the day, a CEO has to do 3 things. He has to recruit engineers, he has to sell customers, and he has to raise capital from investors. And I'd say in clean tech, that latter one, raising capital from clean tech is, from investors for clean tech, is probably the most important. So you got to have a stomach, wherewithal, and long-term view. So that's my comments, and I'll turn it back.
That's great. Thanks, Ray. I like that baseball analogy, and I just kind of look at the portfolio of clients that we deal with at Silicon Valley Bank, and it is kind of like the 3rd inning, right? I mean, you know, it's not, I'm a recycled hardware guy, and, you know, many of those companies in that sector kind of seemed like it was in the 8th inning. A lot of mature companies, and certainly in the early stages. So the next panelist I'd like to introduce needs really no introduction. He's kind of a famous Valley brand name, Pierre Lamond. Was a pioneer in the semiconductor business, spent decades at Sequoia, and is now over at Khosla. And it's our pleasure to have Pierre come up and see if I can get this presentation up. See what I can do here for you.
I think that's me here.
Wait a second, right here. This one.
Yeah. Try it.
All righty. I don't know. We're in a little tech support here.
I think
What's that?
Your original slides are in the lower right-hand corner at the desktop.
go back.
Yeah, it's just doing this. Oops, I
He's
want to do that.
nearly as good as you are, Doug.
Yeah. So the lower right-hand corner, your stuff is where? You mean it's down? I'll let you
You got
handle
to,
it.
it's
let's
hidden
hide it.
behind this. Okay,
Alright,
try this
that's
one
all.
here.
That one?
Yeah.
That's raised. I think it's raised.
Oh, yeah.
Yeah.
There it is. It's on the left.
Oh, there it is, right here.
Yeah.
Let's pull it up. All right.
Not quite right, but
And that's pretty straightforward. There you go.
Yeah, thank you. And we like to call it main tech because clean tech is so diverse that there's more than just one technology involved. Khosla Ventures has a core philosophy is to invest in technology-driven innovation, and we try to make sure that we make investments that are driven by the economics as opposed to a fad or whatever. And while we'll take science risk, we'd prefer not to take market risks. I'm going very fast because Doug threatened me yesterday that you better do this in 5 minutes or less. So I may go even faster. Just want to give you an idea of our main tech investment. We're still very active in this domain. As you heard from a few minutes ago, the atmosphere is not very optimistic, but we feel that eventually things will turn around. And before we started this meeting, I was mentioning that, you know, about 2 or 3 years ago, everybody was saying that enterprise software is dead. There won't be any more companies in IT started, and just look at what happened between big data, cloud storage, cloud computing, etc. And there are quite a few very successful companies in the making there. But I wanted to give you a little bit of a background, a landscape of what's happening in this business. The historical average annual energy subsidies, this is annual, is $5 billion for oil and gas, is about $4 billion for nuclear, about $1 billion for biofuel, and less than $400 million per year for renewables. That's one of the problems we have. The other problem is what we are up against. There's tremendous amount of subsidies for consumption of existing fuels like natural gas, coal, and so on and so forth, both in developing countries and in already developed countries. Clean tech investing, if we look back at it, you know, the number of deals is dropping. The amount, by the way, there is an error on this slide. It's not in billion, it's in millions. But, you know, I'm not very good at correcting my own mistakes, I guess. But I wanted to give you an example of a place where we have had 3 companies that have done very well. Cure, the stock is way down, but the company is doing well. It's created a opportunity for 1,000 jobs in Mississippi. Solidigm, same thing, about 300 jobs, and Scion. So, you know, when one talks about clean tech or main tech, it is a job creator. If we know how to invest the money, we find the money. And in this case, the state of Mississippi, Hallie Barbour, not to name it, arranged to borrow money with bonds to fund these companies. And it is not a subsidy, it's a loan. For instance, I can tell you Solidigm has a loan of about $40 million from the state of Mississippi, which they have to start repaying as soon as they get revenue, which is happening as we talk now. So it's possible to do. But clean tech is just not one thing, it's more than one thing. And this was for art, but I want to show you something else. This is our view, briefly, of what we think could happen in 2013. Wind farms, not wind turbines. I think from an investor point of view, not that we would necessarily at Khosla invest in wind farms, but wind farms is an area where somebody can make money. Wind turbines, startups in wind turbines, in our view, are doomed. Solar farms, much better than solar cells. I assume I don't have to. I hope that most of you know that there's not one company that I know of that's making money in solar cells these days. I was just reading this morning a Chinese company, I won't name them, that in their report they mentioned that their gross margin is minus 1%. Saving energy, not generating energy. Saving energy is more important in many respects from an economic point of view than just generating energy. And finally, storing more energy is more important than making more energy. And one of our themes, if we end up talking about this later, at Khosla is to invest in storage type devices, be it batteries or other storage systems. But the golden rule is, if it is not economic, it doesn't scale. If it doesn't scale, it doesn't matter. I told you 5 minutes.
All right, thanks, Pierre. Our last panelist is Stuart Bernstein. He's a longtime Goldman exec, and he currently is the global head of Clean Technology and Renewables Group. And I'd love to have Stuart up, if I can get his presentation up, so he can talk a little bit more about Goldman Sachs' commitment in clean tech and his activities. Okay. Oh my goodness. Let's try it again. All righty. Just ding it. And now. All right. Yeah, maybe we'll do that. Well, it says it's doing something. Dude, I don't know what's going on. Is that one? All right, we could do it again. Just close it. And now, okay. You might have better luck than I. What's that?
Are there any engineers here that can help us out?
Hmm?
Bottom bar, right click,
Bottom bar, right click.
like in the middle somewhere.
Uh-huh.
Task manager. Task manager.
Got it?
Look for Adobe, and yeah, after you just kill all of those.
And then end task. I got it. And now. Got another one? And task. And now.
Silicon Valley Bank's going to pass wine around while we're doing it.
Whose computer is this? Yeah, don't sound. You might just need to. Do you guys? Whose computer is this? I mean,
I'll do it without. I'll do it without.
you
the
might need
slides.
to do without. I'm not sure we can get you up there. There you go. Let's go. You know, test manager. All right.
There must be a joke about what two bankers can do.
Yeah.
This takes me about 3 seconds. I'll just do it without the slides.
You just need to
There's
kill
so
all.
many.
You just need to kill all of them.
Can you highlight them all at once? And then kill them? Or no?
Maybe.
Feel a little bit.
Tell you what, I'll just start while he's doing this. I have 10 slides. I'll cover 2 in the interest of time, and then maybe we'll reference the others. So I joined Goldman Sachs in the mid-'80s. I spent my early career covering energy companies, utilities, independent power producers, ran our technology capital markets business for a long time, and then more recently ran our financial institutions capital markets business through the financial crisis. And then about 3 years, I did something which is a little unusual at Goldman Sachs, which was a 32,000 person organization. But I created a startup within the firm, which was actually surprisingly and nicely easy to do. And that was to create a new vertical, which we call Clean Technology and Renewables. And while we'd been in the space for 6 or 7 years, we didn't have a vertical within investment banking. We had the same 4 or 5 verticals for the last 40 years. And our mission, quite simply, is to advise, finance, and invest in the premier clean tech companies globally. And we have a very broad definition of that space. It's the obvious ones like solar and wind, but also biofuels and electric vehicles, storage, et cetera. Just to give you a bit more sense on those 3 categories, On the advice side, it's what a traditional investment bank would do. We start, there we go.
Thanks, Mike.
And now to go forward. There we go. Oop. You saw an early sine wave. So here are the three pillars. We advise companies. We start early in their history to try and give them a sense for what to expect as potentially a later public company. We finance companies, and that's everything from private placements to IPOs to follow-on common equity financing to convertible financing. And we actually just closed a very large tax equity financing package. And then we invest in companies, and this is actually off our balance sheet, so we don't have any limited partners. This is the Goldman Sachs balance sheet, and it's late stage financing. Everybody asks what that is, and I define it as the last round or two before a company goes public or gets sold, typically 10 to 25 million in size, 10 to 25 million. We've done about 8 of those investments since we started about a year and a half ago. We think this is a very important market. The energy needs can be met in a sustainable way over time. And we view it as one of the most attractive emerging markets in our business. So Goldman Sachs coined the acronym BRIC. I'm sure many of you have heard of that, Brazil, Russia, India, and China. We view the clean technology and renewable space as another very large and important emerging market. And you can see over $600 billion has been spent over the last 10 years. And by 2020, almost $400 billion will be spent a year in this space. About 2005, we announced a commitment to the space and said we would invest or finance $1 billion over the next 10 years. And we actually invested $4 billion and financed $24 billion. And then in May of this year, we made another target, and we said we would invest or finance $40 billion over the next 10 years. So that's what our team is committed to doing. It's a global team. I'm based here, but we've got people in New York and London and Hong Kong and Beijing and Sao Paulo and elsewhere. Other 8 slides we'll use as reference to the extent that people want to talk about this space in greater detail.
Great. Thanks so much, Stuart. All right, the next technological challenge. Okay, so I've got, I think this is a working mic. Yep. So 2 good pieces of news. Now we're going to get into the more interactive part of the session. The other piece of good news is there are no more PowerPoint presentations allowed. So, kind of I thought of this in 3 different sections. I kind of figured if you're looking forward, right, what are the new opportunities in 2013? It's always to get a bit of a benchmark and look back. I think to look forward, you need to you got to look back to look ahead. And then I kind of want to talk a little bit about have the panel talk a little bit about kind of what are the characteristics of what makes an attractive new opportunity? What's the anatomy of it? In other words, we can get into it a little bit more. And then from that, I think we could move into maybe some sector-specific areas as well. So we'll go through those. But I thought maybe we could just go across the row. You know, we all can read the stats, what got funded, what didn't, the number of deals, the number of dollars, the IPOs that were withdrawn, the IPOs that went out there, and you know, as it was pointed out, you know, Tesla's the only one that's trading above its offering price, but stats and kind of what folks' perceptions are and kind of summaries could be a little bit different. So I thought we'd go across. We'll just start with Stuart here. And so really the question is, you know, how would you characterize the clean tech activity in 2012, the highs and the lows? You know, you can do it in terms of, you know, your experience, which might not be new company formation, might be starting from exits. Others, you know, the ideas are to talk about, you know, sectors that people avoided, the most favored sectors, the least favored sectors, follow on versus, you know, new company formation, appetite, whatever. So the main question is, how would you characterize the clean tech activity in 2012 that'll set the groundwork for talking about 2013?
Well, there's a slide in this deck which we can open if you like. Actually, it's already open, so it might be easy. But I call it "Life is but a sine wave," and I say that because our space is incredibly volatile, but any emerging space is volatile. We just have greater amplitude than most. So I hope that 2012 represented the trough of the latest cycle for clean tech. It was, and it continues to be, an incredibly difficult year. My colleagues will talk about the financing market, the venture financing market for clean tech, but from a public perspective, you know, at the beginning of the year, there were over 10 companies on file hoping to go public, and 2 did. Both are underwater. As Ray mentioned, 9 out of 10 IPOs in the space are underwater and meaningfully underwater. And by the way, let me just back up by saying I am long-term bullish. I'm intermediate-term bullish, and I agree with the assessment that we're in the early innings. But you know, the short-term prospect is very difficult. So if you look at how many of those 10 companies can go public, and just imagine they're all planes circling the aircraft carrier trying to figure out when they can land and waiting for their capital markets person to tell them it's safe, and they're running out of fuel as they're circling the aircraft carrier, and a lot of them are, you know, going to hit the aircraft carrier or fall into the sea. And so part of our business, unfortunately, is distressed sales because some of those realize they'll never go public. They can't raise capital, and they've got to figure out a way to sell themselves, and the most likely acquirer is a strategic, and sometimes that buyer is a foreign strategic player. So I'll end with that bad news. The good news is there are a number of interesting companies out there. Some are looking at 2013 and 14 to go public. You know, people always ask me what spaces are interesting or what's hot, and it's hard to answer that because it's temporal. It really changes depending on almost the month you ask people that question. So we look for great companies, and there are great companies across all the sectors we've all been talking about. But in the efficiency space, there seems to be potentially an alignment between well-run companies and companies that the public markets will invest in. Why is that? Because the public markets have seen a number of companies either go public or try to go public. They view the industry as incredibly capital intensive, and that's not necessarily a bad thing, and some companies are, but not all companies are. But in the efficiency space, there are fewer companies that are capital intensive. They reach profitability more quickly. Many of them have SaaS business models, so there's a predictability and visibility of their revenue stream, and the public investors will find that attractive. And our hope is that once some of those companies go public and they succeed, defined as trading up after they go public as opposed to trading down, others will be able to follow them. One of the things you see of these 9 companies that are not trading above their IPO price, they're trading at a third of fundamental value, sometimes a fifth of fundamental value. What I mean by that, if you talk to buy or sell side research analysts and you say, what's this company worth? Do a DCF, any metric you'd look at, they're trading at X, and they should be trading at X, and they're trading at 1/3 or 1/5 of X right now, in part because the universe of clean technology investors has narrowed considerably. You know, there used to be dozens, and now there may be, you know, 2 and a dog that are invested specifically in this space, and so you've got to attract other investors, growth investors, small cap investors, energy investors to come into the space. So I'll stop there and hand over to my colleagues, but you know, that's sort of the short term. Again, long term bullish.
You want to pass? I agree with you. I think the environment for companies in this sector beyond Series A, and now I'm talking purely as a venture capitalist, beyond Series A is very difficult. As soon as the company has raised enough money to basically show a prototype, let's say, and they want to go to pre-production or let alone production, and they look at the amount of capital needed to do that, you can't find, well, you may find 1 or 2 venture capitalists that are interested in following, but it's very rare, very difficult. So what do you do if you're running such a company or if you're an investor in such a company? The only thing left is really to look for a strategic investor. And unfortunately, not many American companies are interested in investing in clean tech. So the strategic investor is not American. He may be Chinese, he may be Russian, he may be French, German, anything. but American. And it makes things very difficult for a small company because when you have no sales and you're trying to raise, let's say, $50 million or so to start a pilot plant, explaining what is the company to a German investor is very difficult. They're just too conservative. You go to China, you get a lot better reception. The Chinese basically are interested in buying, that's a euphemism, but you know what I mean, in buying American technology. And I find quite a few of our companies that are turning to China for the next round of financing with a strategic partner.
I got this here. Is this on? Yeah. Okay. So a lot of it's already been said, and I touched on it earlier. You know, the number of venture firms doing Series A clean tech is shrinking. And I think we had like 22 up there. It's probably 5 or 6. A lot of firms have moved their partners out or onto other sectors to go after. So it is very difficult to build a syndicate that can last a long time. That is partially forced on us by the LPs, who are all very grumpy. You know, after the 00 decade where they had minus 3% ROI, and this data is sort of across the industry, so I hate to always use a big paintbrush, but I can do that being with the MVCA. They're very grumpy. In 08, they needed liquidity, and they went to the venture capitalists. They went to the private equity guys. They wanted their money back or at least some sort of return, and so they put enormous pressure on the GPs, who of course pass that down to the entrepreneurs to do something interesting that'll create value fast and create liquidity even faster. And that is an unfortunate dynamic that I think is kind of here for a while. I don't know if it's cemented in, but it's a powerful thing because money speaks. This is a capitalist economy we live in. So we have to address the industrial sector, as Pierre was talking about, and it's mostly foreign companies or sovereigns. We have a deal. We've got several sovereigns in it already, and I think we're going to be fine raising more capital. But it is really a cold, hard locked door in the United States, and it is unbelievable. Some of our deals have done amazing things technologically, and you can't even get an American company to even take your meeting. It's really amazing, and their balance sheets are loaded with cash. It's like, you know, so I don't know. There's just something wrong in the psyche. So we have to be more creative. There are fewer people to do things with, but we got to go. So the big things are oil and gas. Now here we go, right? Remember the 70s when oil went up and then went down and everyone forgot about the energy crisis? I feel the same thing is about ready to happen again. You know, oil's whatever it is, we're going to be the world's largest exporter of oil. I mean, give me a break. You know, our energy load just keeps going up. I think the most powerful thing that's going to affect energy is distributed energy. Can you imagine if you get a lot of rooftops with 10 kilowatts or 5 kilowatts, you don't have to build that next power plant. So those utilities are spared from investing whatever it is, multiple billions in a 70 or 80-year investment. Those boards no longer have to make that decision. What a really interesting opportunity. But you do have to, we do have this regulatory framework that is just a bear to work through. But distributed power, oil and gas is a problem. You know, it just scares everybody. And the other thing is climate change. You know, I would love to take a show of hands, but I did take a show of hands at the Harvard Business School. This is a fact. Half the professors at the Harvard Business School do not believe there's climate change. And it is amazing to me. Yeah, I mean, it's I was just there a couple of weeks ago doing some things like this, and I asked to raise a hand. I was just blown away. So corporates have the cash. We got to be better stewards of our startups. We have to do this. We are in the third inning. It is a long-term bet. I love the fact that, you know, my days working in the Rockefeller office when it was purely Rockefeller and it was long-term, and we talked about 10, 20-year kinds of projects. We somehow have to find that DNA back in our system, and I hope that with the DOE's help, with ARPA-E and DARPA, which has been a huge source of capital. I know, Pierre, when you were at Sachs, we've done so many. The opportunities are immense, and we just have to somehow get that innovation R&D engine kicking again.
Yeah, I mean, from ARPA-E's perspective, I think we have seen actually tremendous support, I think, from strategics. So many of our project teams have strategics on the projects with them, right? You've got everything from the GEs to the Johnson Controls to Fords to AMD and the like, you know, Shell, and so we're obviously talking about a different place in the whole ecosystem, right? That they are investing as all ARPA-E grants require cost share, so everybody's got skin in the game. But we are talking, $3 million grants with 20 to 50% cost share. So we're not talking about BCD rounds of funding large plants yet. But I am encouraged by that we have seen a tremendous level of interest and support. We constantly have questions coming in from strategics. What are the areas you're looking at? Do they want to tell us? We had Schlumberger in the other day, right? We're talking about what are they interested in. It does go back, I think, oil and gas. But as well, I think distributed, net microgrids, however we want to talk about it. But, integration of renewables, storage is very, very important. I do think we're seeing a lot of interest in technology, motors. Generally, I'll take them from the ones we're investing in with low rare earths all the way through to improvements in internal combustion. Power electronics, I think we've seen a lot of, very interesting pieces there. And so, and even the seed companies, when you start to get over to the fuel side, right, they're dealing with the long-term, prospects here of creating options. But I think they're trying to juggle dealing with, today they're developing drought-tolerant seeds. They're not on energy crops yet. So I do think this is a long-term game. And we're in a little bit different position, but I am actually encouraged that here in the US, we're having a much more realistic conversation that innovation and actually manufacturing are tied together, and that everybody's trying to think about where and how do they do that. We certainly hear folks like GE talk about having put their first new product into their Kentucky facility in 40 years with their new water heater. But these movements are happening, and maybe it's not fast, but it is moving. And I think it's an important piece of that ecosystem.
If I may add something that might create some interest in the part of the audience, I personally think the Department of Energy is partially responsible for our problems. Because, and I don't know if you see the same thing I do, but you go and talk to somebody about anything that has the word solar in it, and the first answer you get is Solyndra. Then you go and talk to somebody about a battery company, and the next thing you hear is A123. So the Department of Energy, by giving money out to companies the way they've done it, has actually hurt, not helped, but hurt the business, in my view.
So I wanted to talk a little bit about the fundamentals of going to keep it moving along of where new opportunities are, and new opportunities need a lot of tender loving care, but they start with inspiration, they start with ideas. And so this is kind of a question, well, it's for anybody, but kind of for Cheryl and Pierre, since Khosla does a lot of very, very early stage investing as well, is what's the pace of innovation like? I mean, is it such a kind of hostile, funding environment that it's squashing people's zeal and interest in coming up with new innovation, or is just new innovation, happen because people have great ideas and it's kind of a little bit independent of what the environment is?
Well, we're constantly looking for new technology of interest, and we're finding a lot of good stuff going on in universities and elsewhere. But we're also looking at expanding the domain, and we've made in the last 2 years or 2.5 years a number of investments in sectors that you might not consider purely as clean tech. Like, for instance, we invested and we are looking at deals in agriculture to make grazing crops more efficient, requiring less artificial things like nitrogen and other fertilizers that are pretty ugly, frankly, from an environment point of view, trying to help the farmers use the right amount of fertilizer, not too much, not too little. And we made a lot of progress in that area. We have one company working on that's doing very well. We have a couple of other companies looking at finding other ways to help agriculture. In this case, it's primarily weeds eradication. I won't tell you very much more about the technology, but it's a clean technology. It doesn't use chemicals. It's much faster. It's cheaper on a per acre basis. So these type of things, I think, fit, you could say, in a large portfolio of clean tech, and we are very very involved in this area. The other place where we've made a couple of investments or bets, whatever you want to call it, is in food. Without going into boring statistics, protein manufacturing of proteins through animals is a very inefficient process. Can we find a way of feeding the 9 billion people or so that will be around in 2050 without dramatically increasing the herds of cattle, which, by the way, today use about 2/3 of the available land on Earth. And so we have what you might consider as a crazy way out there type of deal, trying to find a way of making artificial meat. By this I mean meat made with vegetables that you can grow. And making a hamburger, or making something that looks like a hamburger, smells like a hamburger, tastes like a hamburger, has the same fiber content as a hamburger, is actually not easy. But from a Thank you. I'm not the one trying to do it, by the way, but it's a professor at Stanford that started that. But I thought, I don't know if that's going to be successful. It's too early. This is a seed financing, and we'll find out in 4 or 5 years. But that's the type of area that I think is very promising, and where we hope investors will say, okay, there's a big opportunity. It doesn't require hundreds of millions of dollars to start a business, and the demand is universal. It's not just in developed countries, but it's also in China, India, Africa, everywhere else. This is just to give you 2 examples that clean tech is not just batteries and reducing the amount of electricity we use, or making fuel more efficient engines. It's a lot more than that.
Yeah, we've not seen any drop off in what I would call, core ideas at all, right? In our most recent, open call, we had thousands of concept papers come in, right? And we culled that down to hundreds of full applications to come in to result in the 66 awards we gave out. And we still have the situation where we don't have enough money to fund all the ideas that actually fit in the ARPA-E mission, let alone the ones that are still good ideas, but we can't fund them because they're not actually just in our swim lane if you think about funding. And so, I don't think that the ideas are diminished at all. And I actually think we're seeing people come in with better understanding of some of the constraints of the spaces that they're inventing into. I think there's more awareness now, and of what are some of the issues in. We've just funded, 7 or 8 new types of solar projects. People are coming in understanding what are the things you have to think about if you're going to succeed in this space. We've funded things, again, in storage, in grid level storage, as well as in some EV type of storage. And so, I don't see it that it's diminished the ideas. I think the key thing for us is we're not playing for, we're going to be 3 years till we're done with these projects. And so key is understanding what's the dynamic and making sure our teams know that. There's places where venture's never going to be the right funding for them. It's just not a venturable model. On the other hand, you have to help understand, what it is and who's interested. And maybe it goes right to a strategic. And so do we have the right relationships as ARPA-E with the strategics to have that conversation broadly early enough? Is it something where we can get them to demonstration test beds, either here or not in the US at all, around some things, so the military, huge amount of military interest, and from a national security perspective, microgrids, a lot of these areas. And so they do fund, not just fund the next stage, but they fund the next stage recognizing that that project team really needs the data from the project to get to the point that, you know, Goldman might be able to step up and fund them from the next stage. They have enough data to be compelling to get a, you know, a growth contract out of them. So I think it's really about us funding the right people, helping them understand along the way what's the right path to the next step.
I'll make 2 comments about innovation. So a couple of years ago, the DOE asked me to prepare some remarks for a meeting they had, and so I called all my favorite venture firms that were in the energy business, and I collected up, I was interested in where the seed corn, where's the innovation of the deals they had done, where did it trace back to? And of the group I called, I rounded up 100 deals, or 99 deals, and it was not what I expected. 150 of the 100 deals, so half of them, were garage inventions. People with ideas, people that were worked on it, whatever, just, you know, just like good old Silicon Valley kinds of stuff. That was really kind of interesting. 2/3 of the remaining 50% was out of university, which was funded by generally the US government. The remaining piece, a sliver, single-digit percent, came from the national labs, a $5 billion budget, Department of Energy, and 5% came from private foundations. So, you know, and then if you look at where that technology had been invented and by whom, and sort of, it all comes out of graduate school for the most part. I was sort of amazed at the lineage of some of this technology, but it all points back to the US government. So I think the Department of Energy does do a lot of good things. I wish they'd do more of this. I wish they'd fund more graduate students, more graduate programs, more ARPA-E, and do less of the national lab stuff, because it's clear the national labs are not generating the innovation that becomes commercial. Either you got to break that model, turn it upside down, do something different than what we've tried. And there's been, you know, venture capitalists walk the halls of national labs. We all have. We've all taken these trips. And it's very frustrating. I mean, these people are terrific thinkers and inventors and all this stuff, but they're a national lab. They're not entrepreneurs. So I think the dollars need to flow to graduate students. And when Secretary Chu got $39 billion back in '09 after the Recovery Act was passed, I said, man, he ought to just pay everybody's graduate education and just, you know, do the STEM across the nation. And then, of course, staple a green card to all those 40% foreign graduate students. But the point was, we have it's a trivial amount of money. I mean, the National Institute of Health is $30 billion. The DOE only gets like $5 billion. It's nutty. So I think that. The other thing is that if you look at R&D in the United States, it's 3.5% of GDP, about 500 billion, I think is the number. And only a sliver of that is for new things. Most of it is corporate R&D to make better sugar, or better, you know, for your frosted flakes, and better chocolate for your milk and stuff. It's amazing the amount of R&D that is for small incremental things, and that was very depressing for me when I was at. So it is all about young people getting funded who don't know that you can't do something, and I think that's really where the action is.
So if you have a backdrop where, you know, innovation is, you know, strong, but what makes companies is innovation and capital, and what generates capital is in some ways kind of show me the exit, right? I mean, I kind of sense a real hesitancy in the venture community. You know, there's not that much what we call new, right? And we've seen some some firms really stand behind kind of their mid-stage investments, protect the investments, see that there's long-term potential there. But it kind of seems that what would really give a good caffeine jolt to 2013 is if there were some successful exits. And this is kind of a question for anybody, but particularly Stuart, of, you know, are we going to see anything in 2013 that's going to be different than 2012, or is 2012, it's got to be the low point with, you know, all the IPOs being withdrawn, you know, and, you know, you see there's M&A activity, there's good M&A, right? There's the distress, I mean, there's good M&A, like, I guess, an AgriQuest M&A, and there's kind of M&A which is kind of distressed M&A. What do you think that we'll be seeing in 2013 if you had to get out the crystal ball?
Well, again, just to provide some context, just in the years that I've been in this business, people have almost given up, not just on this sector, but on technology sectors and other sectors more broadly. You can go back, you know, the crash of '87, '91, '98, 2004, 2008. In every one of these periods, people were wondering whether the IPO market would revive. I don't know, I guess the slide's now gone, but there's an image I have of this market which is falling, and it shows high unemployment and anemic GDP growth, and weak housing starts, and everyone kind of nods, says, yeah, this market's horrible. And I say, wait, that's not today. That's the tech market in 1990. And if you then blow that slide up, you can see that over a very short period of time, NASDAQ more than doubled, and there were thousands of IPOs that took place. So I think it's important that we, view this in a broader context. So and I'm an optimist, so I believe 2012 perhaps represents the trough of this sector. But we're also, and everybody's heard this expression, a lot of these companies are in the valley of death, crawling to try and get to the other side, and hoping they have enough water to do that. And some of them are going to get funded, and they'll get to the other side, and others will starve or die before they get to the other side. But that's a natural evolution in any new emerging space. To answer your question, in 2013, there could be success stories in every one of these fields. So take the most out of favor, and I can't talk about any specific companies, just given what I do and the fact that many of these companies are in registration. But solar, the most out of favor subsector within clean tech, there are still really interesting companies that are developing technologies at a very high efficiency and can compete with Chinese manufacturers, will compete with Chinese manufacturers, and if they can just make it a little bit further to get to positive gross margins, we'll see some of those succeed. Many will fail, but some will succeed. That's the worst sector you can imagine right now. Even in storage, I think we'll see we've seen some really fascinating technologies funded by ARPA-E in storage, and those will take 4 or 5 years to kind of get to the point where we'll see if they can make it to the capital markets. We see there are tremendous innovation. Just to your last question, a lot out of MIT. I see a number out of Berkeley, and the enthusiasm is still there. And as long as the pipe that we're trying to push things through doesn't get completely jammed, they'll make it through the other side too. But in the near term, as I mentioned earlier, it will be the capital light business models, the ones that can generate near-term revenues, near-term positive gross margins, near-term profitability, that have long-term contracts that allow investors to see the visibility of those revenues and those of those earnings that will succeed, and they exist. So I can think of 3 companies now that will probably file next year, and I'm pretty confident even in a market like the one we have today, they'll be able to go public. Many of them, a couple of them in the efficiency space.
You're talking about company in the efficiency business. One of the problems in clean tech, let's face it, it's very heavily capital dependent. I mean, you can't build a factory. Look at the amount of money that has been spent, not just by the Chinese, but American companies to make solar cells. If you want to build a battery company that provides, let's say, 200 megawatt hour per year, you've got to think about, top of my head, $130 million of capital equipment. That's a lot. Mm-hmm. And when you think that the company will achieve maybe 35% gross margin, the ROI is not great. And the investors are smart. You have to assume that investors are not dumb. And they will not invest unless they feel that the investment they make is going to be really profitable for them. So while I totally agree that, the companies you're talking about to me are software companies. They're not hardware companies. The tough part, the one that I think Ray and I were talking about earlier, is the companies that are in hardware. And while and I did some investment in the area of healthcare in the past, healthcare suffers from one thing: it's FDA. But otherwise, you could really basically see what would happen, and then the company would be in phase 3, and you would get a big pharmaceutical to buy the marketing rights or something like this. You don't see that happening in clean tech. That's the problem we have. It would be nice to have a strategic that would say, well, it would not be a bad idea for us to get into a new business and invest in this company that's making, I don't know, wind turbines or something like this. But I don't want to conclude, by the way, without telling you one thing. I wish the Department of Energy would give you more money. Yes. Because ARPA-E is the hope, to tell you the truth, from my point of view, just like DARPA is in many respects. I think if you had more funding, it would be a much better return on investment for the Department of Energy than to, as you said, give money to, I hate to say it because there may be some people here from the national labs, but frankly, I don't see anything.
in the parking lot.
Say something. Say something. I don't want to be alone. Say something.
Well, that's all right.
I just want to make a comment.
Nobody would dare touch me.
That's right. So I hope you're right, Stuart, that some of these efficiency deals, but personally I don't buy efficiency as Americans consume. We don't save. We never have. And we ought to be able to make it cheaper. That makes our consuming go up. So I hope you're right, but and I've gone around my house, and I've got timers on all the major appliances, and I shut the pool pumps down and all that sort of stuff. But I got to tell you, it's all about supply and supplying it as cheaply as possible. We live in a capitalistic society and we consume. That's what I think the big opportunity is in energy. Buy more electrons.
So it's about 8:30. I wanted to make sure that we had time for questions on this. So we're probably going to skip that last little section, but we did it last year, and it's what's hot, what's not, and maybe we can kind of run through some of these. Maybe what we could do is have each of the panelists kind of. I'll run through some sectors and choose one you think that maybe could be a bright area in 2013. Could likely be one that you have a major investment in. But so we'll run through some of those. So there's solar manufacturing, solar finance, storage. That's so huge. It's consumer transportation. It's grid scale. Smart grid, lighting like LEDs, building controls, kind of software type stuff. Smart buildings like e-glass. Transportation, meaning electric vehicles, could be or just charging infrastructure management, things like that. Food and ag, and water treatment. So just wanted to kind of choose one, what you think is that might be one of the areas of promise, and say a couple words about it, and then we'll open it up for some questions.
So what's our time frame for this investment? Just 13? I don't think in terms of 1 year. So you didn't mention nuclear.
Yeah, I didn't actually. There we go.
There we go. It's a long-term bet, and I'll take the FDA over the Nuclear Regulatory Commission any day, by the way. Nuclear, just to put some context on it, it's 2,000 times a pound of uranium has got 2 million times as much energy as a pound of coal, and a fusion is 7 times more powerful than uranium, than fission. So I think it's all about these long-term bets. It's all about putting something down. But if you're going to force me into 2013, I do think distributed energy, and any time an energy concept can jump on the back of Moore's law, whether it's a semiconductor implementation, something, computational capability, anything that can get on Moore's law and ride that curve. I have watched physics evolve over the last 20 years from lots of laboratory stuff to simulation in a computer. And when you can get in that, boy, you can ride those curves so fast, and computing is so cheap. So I think I encourage all our companies, all our portfolio, to simulate this stuff before you build anything. So that might actually be an investment area for energy, is in better simulation, better physics simulation, computational chemistry. The pharmaceutical guys just made a killing out of that about 15 years ago. Those are the kinds of places I would go.
We're running workshops.
Oh, okay.
Well, I'm happy to see there is somebody still in favor of nuclear, because I thought I was by myself. But I don't think that you'll see nuclear in this country. I don't think so. I think it's an issue of public opinion is totally against nuclear. And we have a small investment in nuclear. It's public knowledge, and the first reactor to be built will be in China. And that's the way it goes. But you ask, is there any company or any sector that I think will do well in 2013? I do agree with you, by the way, on the issue of efficiency. I don't believe in it. I find it's very interesting. I turn off the lights, but my children certainly don't turn the lights, and my grandchildren for sure don't turn off the lights. So efficiency is not in the American genome. But I think that these companies might do okay. Not great, but okay. I don't see any early, low-hanging fruits for 2013. On the other hand, 2014, I think that you could say that some companies in the storage area, you talk about distributed energy generation, I'm saying distributed storage, which is in some respect the same thing. I think that's going to be successful, and there will be some companies in that area that will succeed. I'm afraid that when it comes to transportation, except for Tesla, who up to now seems to be a reasonable success, I don't think any of these Fisker and other companies will make it, personally. I hope there's nobody in the room that's going to wait for me in the parking lot.
To drive your Fisker down.
Yeah, with my A123 battery. For full disclosure, when I was at Sequoia, I invested in A123, but decided not to invest in any of the further rounds. That was a pretty good move from a financial point of view. But there are some other sectors, but they are pretty small areas where one could say something can happen. But I don't see any big thing in 2013 or 2014. I'm like Ray. I don't think in terms of when you make an investment in venture capital, you can't say this company is going to go public in 5 years, no matter what, because generally that doesn't happen. You have to be patient, and I think that if you look back at the history of in general of venture capital, it doesn't take 3 years or 4 years. It takes 5 to 7 years, or even sometimes 9 years before a company matures, has enough sale, profitability, and history to go public. And the public will then, they look at 2 years of balance sheet and P&L and cash flow and say, this is a real company. That's when you want to go public.
Just to add two thoughts. Oftentimes we see in our business solutions looking for problems, and that's never the right way to start. But if you think about big problems, one is in the waste area. Landfills are full, and so there are companies that are trying to address that. For example, when you take a bottle like this, most people think that if you put it in a recycle bin, it gets recycled, but actually 70% of them actually still end up in the landfill because the cap is a different consistency than the rest of the bottle, or there's the plastic label on it, or there's something printed on it. All those reasons cause it not to get recycled, so there are companies that will take something like this and turn it into oil. There are others that will take organic waste, and again, instead of going to a landfill, they'll take that organic waste and turn it into mulch, fertilizer, and then energy. So they get paid a tipping fee to take that organic waste. That's a source of revenue, and then two other streams of revenue to turn it into energy or into a product they sell like mulch. So those are other interesting businesses. Water, you could spend 2 hours on water alone. It's a huge problem. There's a lot of wastewater, and there are companies with interesting technologies to refine that water and reuse it. And it's sort of obvious that we'll be in a water-constrained world in the near future.
Can I just make one comment? I'm not a very self-promotional person, but three of us here in the Valley, one other venture capitalist and an entrepreneur, and I have produced a movie. It's called Pandora's Promise. It was just accepted at Sundance. It'll be a premiere showing this January, and it's pro-nuclear, and it features all the anti-nukes talking about how they're for nuclear energy. So I think you may be wrong, but some of us are trying to put forward a different message.
Fascinating. Let's look for it. So we have a little bit of time remaining. I wanted to open it up to the audience for questions. The best way to do it is to raise your hand and a mic will find you. The gentleman in the third row right there.
Well, okay.
We can hear you.
I can project. So, Bill Reichert with Garage Technology Ventures. Thank you very much. I wanted you to talk a little bit more. A lot of discussion came up about strategics versus traditional. And sort of one of the ironies, and Ray, in terms of the NVCA data, I think the NVCA data shows that there's a thundering herd of corporate venture investors, sort of coming into the space.
Right.
So the question is, will that thundering herd, start writing checks? I guess is the question. Are you seeing that phenomenon of corporate venture that is counterbalancing to some extent all of the dismal, sort of finance that you've been telling us about from the traditional?
That's true, Bill. So the question is about corporate venture capital. So for many years, the last decade, we only had 2 or 3 corporate venture capital members. They were typically IBM, Intel, the usual suspects. We now have 60, and it includes Chevron and Exxon and just the whole list of them. So, we have our meeting in May, and hopefully they'll all come. What I would hope is that someone like the Secretary of Energy, Bill Gates, some people notable that have flipped a bit into energy could bring these people together and explain to them a little bit about long-term venture investing. I mean, they view us as very self-serving, and we are for the most part, but really that, innovation investing is what this is all about, and innovation in investing for the long term is what it's all about. Corporate VCs come and go. Their profits go down. Guess who gets the first job cut? It's not marketing, it's the venture guy. So, and I've lived through that now several cycles, but I hope that this time it sticks. And I think we the NVCA in this industry, needs to do a better job of educating them about what it means to be in this business and to do these investments. Because, a major investor in your deal and suddenly they don't show up, it kills a company in a heartbeat.
I also think we're seeing some move as well, trying out different models, like you're seeing like Broadscale with this new model stepping in, right? The whole idea that you don't need just equity financing, you also need actually, PPAs or something else. So can you get a group of utilities together as, and bring that, so both sides of that together. And so again, early stages, they're just launching that, but I do see people exploring different models for involving strategics, which I also think is encouraging, because I think some of it might be stickier than other places.
Another question? How about the gentleman right here? And I think there was one in the back.
Yeah, so Cheryl, how long does it take from the time you put out requests for proposals till you actually fund a project? I raised $2 million from the California Energy Commission. It took 2.5 years, and we almost died while we waited for the money.
Yeah, so I mean that is one of the hallmarks of ARPA-E, is that urgency to fund, and so we would do a workshop. So from the time we do a workshop to the time we actually put out a funding opportunity could be as short as 6 weeks, but a couple months. This year we put out solicitations in March, April. We announced the awards in July, and we had them contracted by September. And so that's 6 or 7 months, soup to nuts. We just announced the ones from the Open FOA last week, and those we expect to be under contract generally by February. And so we really do view it as very, very important that the cash flow is something that be very respectful of the companies that we're funding. We actually took that as well to our SBIR. We ran SBIR for the first time. We're doing combined phase 1, phase 2 funding, because the idea for us of having a gap in the middle, it didn't seem to be sensible if we're really trying to move things quickly to the market. And it's still small for us. We only funded about $13 million worth of SBIR, but got very, very good response from the community to set that as the whole project set up from the beginning with a hard go, no go. So you still have to go through that phase. but really try to make it efficient for the companies because it's a huge issue.
Startups is every month is an eternity.
Absolutely. So no, we really is a piece of the focus of everybody at ARPA-E.
I think there was a question in the back. Was there one back there?
First question was, a lot of us are defined by our failures. And Pierre, you mentioned that the visible failures for the energy department for ARPA-E being Solyndra and A123. And I think that as venture capitalists, you accept failure as a part of doing business. ARPA-E is a public entity. And so they've been dealing with failures. A, do you think that's fair? And B, how would you address it? The corollary question is, some people have suggested the venture capital model is failed. The Kickstarter, that kind of thing. I mean, it's not necessarily the same order of magnitude, but there is something to be said for it. If you take a big drink of capital and get halfway down, you're screwed. Maybe the bootstrapping model might be more effective. So this may be
I'm not sure I heard the whole question, but.
my question is, what do you do about big failure of particular RPE?
Well, I'm not sure I understood the whole question, but let me tell you why I like ARPA-E. ARPA-E is because they fund early stage company with small projects and basically use their best judgment to see which, at least I think you would agree with me, you try to find things that will make a difference, which could be important, but you don't judge, well, we'll invest in this thing and not in this thing. The reason I don't like money given to companies like A123 and Solyndra and others is their Department of Energy, I think, was, in my view, trying to find winners and losers. And it's tough enough for people like Ray and I to try to find good companies and differentiate them between, I happen to know the people at Solyndra fairly well, and I know the CEO. I tried to invest in Solyndra in the first round. I did not meet their requirements in terms of there is somebody from Solyndra in the room? Okay. I think that if Ray, were you an investor in Solyndra? I don't want to insult you. No. Okay, so anyway, if anybody had looked at Solyndra from a point of view of Ray or myself or any other venture capitalist, or that matter yourself, Cheryl, you probably would not have invested. This is a company that was spending a ton of money, not to make solar cells, but to make equipment to make solar cells. That, to me, is a sin. When you see a company spending a lot more money trying to make equipment to make the product than to make the product, that's really ridiculous. A123, if you want to really know the dirty linen, this is a company that never achieved, at least to the best of my knowledge, a yield of more than 20% making batteries. Batteries is by itself a fairly low gross margin business, and if you're running 20% yield, let's say they are better than that. Let's say they were at 40% yield. You have a negative gross margin. So, whoever decided to fund them made a terrible mistake, and in my world should be fired. But I'm well known for that. So, and it goes on, and there are, I'm sure, some other deals that I haven't focused on or I don't know anything about that were also mistakes that the government should not get involved in deciding, is A123 going to be a successful company, or is it going to be Enerdell, or for that matter, a Korean company called GS. ARPA-E doesn't do that. That's why I like ARPA-E.
Sorry. That's good. I want to take on the question of the venture capital model is broken. Yeah, that's okay. He also said A123 was broken, but that's okay. No, I don't. My chairmanship does end in May. So, the venture capital is not broken. I think the expectations from venture capital are blown way out of proportion. Now venture capital is cool. When I got in the business 25 years ago, you didn't even know what it was. I mean, it simply wasn't part of the vernacular. Now it's above the crease in the New York Times. People talk about it like it's going to save the world and everything. Look, the truth is most deals fail. That's a fact. Most innovations fail. They just don't make the economics. People don't like it, whatever it is. But venture capital is not broken. And why is it not broken? Because their entrepreneurs are still creating ideas. They're still inventing. They're wearing their white lab coats in all the universities around the world, and some of them want to actually be billionaires. And they need capital. And so long as there's providers of capital and there are entrepreneurs with good ideas, venture capital will exist. Now, does it have a cycle? Sure. By the way, someone was mentioning a while ago, the average time from the first Series A dollar to the IPO, based on 2011 data, is 11 years. Now, there are a lot of investors aren't going to stick around 11 years to wait for the IPO. They're just not. It's only the shortest I've been in my 25 years was 4.8 years. It was the lowest it's ever been. That was in 1999. So it's not a sector for the faint at heart. It's not a sector for the quick flippers. It's not a sector. Venture capital is about building big businesses that are going to last a long time. A few more statistics and I'll shut up. Venture capital also punches well above its weight. All in, it's only about $200 billion. All in, out of about a $14 trillion economy. Venture capital companies generate today 11% of all the private sector jobs and have revenues equal to 22% of the GDP. For $200 billion bucks, we do all that. So you got to wait a while. Those companies didn't happen overnight. I mean, people think Google happened overnight and Facebook. They did not happen overnight. So it just takes time. I mean, you have to have a certain DNA that a lot of people got in and a lot of people got out. But I do not think the venture capital model is broken, mostly because the entrepreneurs are still hungry to invent and create value for everybody. So I just, when I hear that, it sort of turns my stomach because I can line up 1,000 entrepreneurs who would, take my money.
All right, venture capital is alive and kicking. So.
Can you find 1,000 LPs? That's the question.
That is the question, Gene. That is a good question. I'll take one.
Yeah. So we're going to do one more question, one final question. Lady up here in front.
I'm not getting the mic. Okay. My name's Milo Werner, and I run new product introduction at Tesla Motors. I loved all the shout-outs to Tesla. So we talked a little bit about the late-stage investing and how it was really hard to raise capital for hard goods companies that wanted to build products. So that's essentially what I do for Tesla. I help them ramp those products. What kind of advice do you have for new startups that are entering those phases on how to launch their product? Should they outsource, or should they hold their place and wait for a better capital market to get investment for their own factory?
Well, a couple of things. Just as there's been this inflow of corporate venture capital in the NVCA membership, so have growth equity firms in a big way. In fact, so big we formed up a separate group within our NVCA organization, and we're having our kickoff meeting actually tomorrow morning. I would say it is probably better to keep as much to yourself as you can, hold out for better capital markets. That would be my personal view if I were running the show. But that said, you could be waiting a long time. So your existing backers have to be ready. But there is a swell, at least that's the data shows, there is a swell of growth equity, companies that have something to sell or in the sales mode, revenue mode. What's happening is there's Series A and seeds, and there's growth equity, and there's not any Bs and Cs and Ds. That's where the vacancy is. But just personally, I don't know, other VCs in here, I would do it myself.
Don't wait. Time is money. Get the product out as soon as possible. that's very, very important because you don't know if there is not a competitor somewhere lurking around that you don't know about. So getting the product out as soon as it's ready is very, very important, even if you have to have a very dilutive round, because it's better, as somebody said, to have a small piece of a big pie than big piece of a zero pie. So my view is if you can raise the money, even though it's dilutive and painful, you should go out and why Tesla is looking for money? Although I have to say you have a lot of courage to be in the NUMI plant.
I would agree with Pierre. I can't tell you how many companies we see that are waiting for the next higher round that ultimately can never raise money, hit the wall. So raise money when you can, where you can, even if it's dilutive, to keep moving forward.
How many cars a week are you making now?
Doesn't Elon tweet that?
I would bet you're making 100 a day. Wow. Huh?
She can't say.
All right.
You have probably 15,000 cars on backlog.
Yes.
Well, I completely agree and respect, especially Pierre and Stuart's points about go fast. A heavily dilutive round really can hit you hard in the gut. So, boy, think through it twice before you do it. I've been there as an entrepreneur, and I've been there as a venture capitalist on the receiving end of such a thing.
Well, I've been an entrepreneur when there was no venture capital, so I understand.
Touché.
Any last comments?
Huh?
Any last comments?
That's my last comment. Yeah, I mean,
All right.
It's the third inning.
Are we done? All right. I'm going to thank you all. Great show.